Welcome to This Explainer, folks. Today, we're putting a true semiconductor heavyweight, Lam Research, on the stand. We're going to run it through the ultimate masterclass evaluation, using the frameworks of some of the most legendary investors in history. My goal here is simple: cut through the noise. We're going to look strictly at the raw data, the earnings calls, and the financial filings to figure out exactly what this stock is actually worth. To figure out if this AI infrastructure giant is a buy, hold, or sell, we're going to run it through 5 distinct analytical lenses: a quick company snapshot, the philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, a classic DCF model, and finally, our ultimate verdict. Section 1. Company Snapshot. Let's establish the ground truth and see exactly where Lam Research stands today. So right now, Lam Research is sitting at $433.33 a share. And honestly, it's been riding an absolute monster wave of momentum, up a staggering 114% so far in 2026. That kind of wild price action immediately tells us that the market has, well, incredibly high expectations. And looking at the financials, you can totally see why everyone's so hyped. The numbers are huge. Q3 revenue hit almost $5.8 billion, with a gross margin right around 50%, meaning they're keeping practically half of every dollar they make before operating expenses. But the real showstopper here is their Q4 guidance. They're projecting $6.6 billion. That's a massive 13% sequential jump. It shows customers are just frantically building out AI infrastructure, advanced packaging, and those next-gen gate-all-around transistors. Simply put, the underlying business is firing on all cylinders. All right, let's move to Section 2, the Warren Buffett lens. Here, we're looking for that wide economic moat and solid, predictable owner earnings. Now, there's definitely some tension here between what Lam does and what Buffett usually likes. On one hand, Buffett would absolutely love Lam's massive technological moat. They've got sky-high barriers to entry and totally dominate in advanced packaging for high-bandwidth memory, which, as we know, is absolutely critical for AI. But on the flip side, major red flags for the Oracle. He notoriously avoids highly cyclical, highly capital-intensive businesses, and semiconductor manufacturing, with its multi-billion-dollar fab build-outs, is literally the definition of capital-intensive. Let's run his numbers, shall we? With a Q3 net income of $1.82 billion, we can estimate an owner earnings proxy of about $1.5 billion per quarter. That's after adjusting for assumed CapEx and depreciation. Now, Buffett would be cheering for management's aggressive share buybacks. They're really eating up the share count. But here's the kicker. Even with a stellar management team and an incredible moat, paying a premium price just totally destroys Buffett's mandatory margin of safety. At $433, he's definitely staying on the sidelines. Let's pivot to Section 3, the Peter Lynch lens. We're looking at categorization and PEG ratios to spot unappreciated growth. If Peter Lynch were sizing up Lam Research right now, he'd probably tag it as a cyclical that happens to be behaving exactly like a fast grower. And that's all thanks to this unprecedented secular demand for AI accelerators and the required memory upgrades like NAND and DRAM. Lam's management even called out in their earnings that this shift is happening much faster than expected. But how does Lynch value that growth? It's all about the PEG ratio, price to earnings divided by the growth rate. Lam's forward PE is sitting right at 41.28. If we divide that by their estimated 2026 growth rate of roughly 16%, we get a PEG ratio of 2.59. Now remember, for Lynch, a PEG of 1.0 is considered fairly valued, so at 2.59, you're paying an absolute premium for every single drop of growth. And doing a quick run-through of his other standard checks really paints the picture of why Lynch would likely pass on this one. Sure, the balance sheet is rock solid, though their cash pile did drop from $6.2 billion down to $4.77 billion recently because of those heavy buybacks. But the real issue, institutional ownership is sky high. Lynch loves the hitting gems, the under-the-radar plays. Lam Research is basically the most crowded trade on Wall Street right now. Because of that bloated PEG and massive institutional backing, Lynch would easily rate this a hold or a sell. All right, let's strip away the AI hype entirely. Section 4, the Benjamin Graham lens. Time for the defensive investor checklist. Graham is ruthless with his defensive checklist. Adequate size? Easy pass, with nearly $6 billion in quarterly revenue. Strong financials and profitable earnings? Pass and pass. They even nailed the dividend record test with a declared 26-cent dividend. But then, we hit a massive brick wall. Graham demands a moderate PE ratio, basically anything under 15. With Lam's forward PE towering over 41, it spectacularly fails this test. Let's actually do the math on Graham's classic intrinsic value formula. The square root of 22.5 times EPS times book value per share, which is essentially a company's net asset value. Now, we have to make a few assumptions here to fill in the blanks. We'll use a standard industry book value per share of roughly $30, paired with an annualized EPS of $5.80 based on their recent quarterly runs. When you crunch those numbers, this incredibly strict formula spits out a Graham intrinsic value of just $62.60. Now, I know Graham's formula was built for the industrial era, not capital light or hypergrowth tech giants, so it's always going to lean super conservative here. But the main takeaway is loud and clear. At $433 a share, the father of value investing wouldn't touch this stock with a 10-foot pole. Okay, putting the guru philosophies aside for a minute. Section 5, DCF and alternate models. Let's forecast the future. To build our base case discounted cash flow model, we have to make some pretty explicit assumptions. We're going to use a 10% weighted average cost of capital. That's a fairly standard required rate of return. We'll project a 15% free cash flow growth rate over the next 5 years, which hugs closely to their 16% EPS growth consensus. And finally, we'll tack on a 3% terminal growth rate, basically assuming the company grows alongside global GDP forever. So our resulting base fair value lands right around $275. But honestly, the sensitivity table is what you really need to look at. Even if we plug in some incredibly optimistic pie-in-the-sky conditions, like dropping the discount rate to 8% and bumping perpetual growth up to 4%, the absolute highest fair value this model can squeeze out is $390. That makes today's $433 price tag look, well, incredibly rich. You're basically paying top dollar for growth that hasn't even happened yet, and then some. And if we run an alternative model using comparable PE multiples, it just confirms this massive premium. Lam is currently trading at a forward PE of over 41. Meanwhile, the broader industry average for semiconductors and equipment is sitting around 34.6. So, whether you're looking at pure, absolute cash flows or relative peer valuations, the math just keeps telling us the exact same story. Lam is overvalued. We've officially run the gauntlet. Section 6, Synthesis and Final Verdict. Time to bring it all together. Looking at our master synthesis, literally every single valuation framework is flashing warning signs. From Buffett's strict margin of safety demanding a $300 entry point, to Lynch's PEG ratio yelling hold or sell, to Graham's absolute rejection, right down to our modern quantitative DCF landing at 275. The data is unanimous. Lam Research is currently priced for absolute flawless perfection. Now, let me be incredibly clear here. The underlying business itself, it is phenomenal. It's a literal cash printing machine riding an unstoppable AI wave, which we clearly saw with that massive 13% sequential revenue acceleration. But as an investor, you aren't just buying a great company. You're buying a stock at a specific price. And right now, the valuation risks are just way too high to justify slapping a buy rating on it. Plus, you have the lingering risk of their China revenue mix normalizing down the road, which could totally squeeze future gross margins. So, our final verdict? This is a solid hold if you already own it, and a strict wait for any new buyers looking to jump in. You always need a margin of safety, and right now, the market is handing you zero. So I'm going to leave you with this final thought. At $433 a share, are you buying a mandatory foundational piece of the AI future, or are you stepping straight into a cyclical valuation trap? Thanks so much for joining me for this explainer. Keep analyzing, keep questioning the numbers, and I'll catch you next time.